Ladies and gentlemen, good day and welcome to the Q1 FY24 earnings conference call of the Anup Engineering Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. Before we proceed to the call, let me remind you that the discussion may contain certain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our business risk that could cause actual results, performance, or achievements to differ significantly from what has been expressed or implied in such forward-looking statements. Please note that the company has uploaded the results, press release, investor presentation, and also the outcome of the board meeting on the website of the stock exchanges and the website of the company. I now hand the conference over to Mr. Nilesh Hirpara, CFO. Thank you, and over to you, sir.
Yes, thank you so much. A very warm welcome to everyone. We are happy to report Q1 24 results, and the number of these quarters are very, very encouraging. We have clocked a revenue of INR 125 crore, a 142% increase over Q1 FY23, with an EBITDA of 28 crore at a 22.4% compared to 9.4 crore in Q1 FY23, which is roughly 3 times of EBITDA of last Q1. PAT stands at INR 18.6 crore at 14.8%, which is 259% higher than Q1 FY23. On a balance sheet front, we have a net debt of 4.2 crores only as on 30 June 23. If I mention about today's position of a net debt, then we are approximately 20 plus crore cash surplus. On a working capital front, as on 31st March 2023, we were roughly 2.8 to 2.9 times. We have now achieved 3 terms. With this, I am handing over a call to Reginaldo D'Souza, our CEO, to share his opening thoughts.
Hello, good evening everyone. Greetings from Team Anup. I thank each one of you all for being on this call. It is always a pleasure to connect and have a conversation on our company's performance. So happy to say that we have finally broken the rings of not so good quarter one with this 125 crores revenue that we have clocked in quarter one. The last historical best quarter one being 52 crores. So it's a substantial jump and a substantial improvement on our quarter one performance. Also, I would like to make a note that now we have 4 consecutive quarters of 100 crore plus, which surely should give us a lot of comfort on the consistent execution and the quarter-on-quarter performance. On the industries that we serve, oil and gas and petrochemicals still remains the dominant portion, with 85% of our revenue coming from these sectors in quarter one. On the product portfolio, again, heat exchangers contributes about 76%, and vessels, reactors, and columns at 21%. Of course, this 21% we'll see an increase as we dispatch our goods from the new Cheddar facility, which is strategically placed to build vessels, reactors, and columns. So we will see that 21% going up in near future. Our pure exports stood at 15%, which we should see going up to 30% by the year end. On the order booking side, of course, there is a very encouraging progress. As aware, we opened the year with an order book position of 530 crores, as on 1st of April. In quarter one, we have a historical best new order book of 240 crores, 240 crores. And interesting fact in that is that 70% of this is pure exports, which definitely augurs well for us in the direction of exports. So what this means, the 240 crores order booking in Q1, is that we have an order book position of 651 crores at the end of Q1. If we consider the plan for FY24 as per our guidance of 520 to 530 crores, what it leaves is about 240 to 250 crores for execution in FY25, which will further build on as we progress into the year. So this definitely should give us a good confidence even in the year FY25. On the capacity expansion, I'm very happy to inform you all that our new manufacturing facility at Chheda, which is approximately 40 kilometers from our existing facility in Odar, Ahmedabad, was inaugurated on 1st of June, and we expect the first dispatch from this plant coming in quarter 2. So with this, we are on track on our guidance of approximately 50 to 60 crores from this new facility in Chheda in FY24. On our product expansion, as I mentioned in my earlier calls, centrifuge, which is a rotary equipment and which is our own design, we wish to now consolidate our position in the market on this product. Mr. Ganpat Chaudhary, who is our independent director, is guiding us on this journey, and I'm sure with his experience and we can make good inroads in considering our capabilities and a strong reputation in the market. On the people front, we've made some good consolidation in the organization structure, and we have a very strong team now of right capability to execute our plans. I can confidently say that I'm blessed having brilliant talent and taskmasters in my team. So with a very good beginning, good order inflow, with the necessary capacity built in to execute, and a strong team to execute the order intake, we should be confident of achieving our plans for the year of 520 to 530 crores and an EBITDA of 22 to 23%. We will continue to stay focused. I take this opportunity to sincerely thank each one of you for being with us and trusting on our capabilities. Thank you and happy to have a conversation.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Reddy from Naredi Investments. Please go ahead.
My name is Ravi Naredi, not Ravi Reddy. Anyway, Mr. D'Souza sir and Nilesh, you did well. So first, congratulations to both of you along with whole team. Sir, my question is, what margin we get in export and what margin for domestic sale?
So if you compare the export and domestic, we would not say that the margins are drastically different. But of course, there are inherent advantages of exports. Number one is the winnability is better for us because there are limited players that we play with in the export market.
Sorry? Yes. Continue, sir, please.
Yeah. So since there are limited players, our winnabilities are better. On the costing side, because of the forex, we are always a little conservative, so there's always a margin for us over there on actual realization. And also the advances in exports are much better as compared to domestic, so we are better on our working capital as well. So all in all, I would say at the order book position level, the margins may not be drastically different, but yes, there are opportunities towards the end.
Okay. And by end of financial year 24, how much total order book we expect? Just one outline we need on this.
So we expect, as per the guidance, we expect the order book position, total new order book in this year to be 600 to 630 crores, around that number.
Oh, very nice, very nice. All the best, sir.
Thank you so much.
Thank you. The next question is from the line of Divya Daga from Vijit Global Securities Private Limited. Please go ahead.
Hello, sir. Thank you for the opportunity. My first question is, in last phone call, you have mentioned that company is in discussion for 3 to 4 proprietary products, which will help increase in value chain. So, can you tell me the status and what are these products?
Yeah. So as we mentioned in our guidance point, we wish to, since our capacity is now in order, are built in, and also we have built the phase 1 in Kheda. For us to now grow up our revenue, we need to move up the value chain in terms of metallurgies, number one, and also in terms of complexities of the equipment. So metallurgies, of course, we are doing much better in a sense that if you look at our revenue growth from the order facility, the capacity remaining the same in terms of tonnage, we've been able to turn out much higher revenues, which clearly suggests that our metallurgies are going up, and that's the reason we are getting better revenues from the same capacity. In terms of complexity of the equipment is where the licenses for proprietary item comes in. As you know, it takes a long time to convince the proprietary licensors and get inroads into their vendor list. We are in discussions. In fact, we had a couple of discussions, very strong discussions in this line, and it will materialize soon. So we'll have to wait for that time period for us to get on board their vendor list, for us to be able to make that claim that we are licensee or registered for our proprietary equipment. It takes a substantial time for us to make the visits, because every licensor, unless they come and visit and see our facility and conduct the audit and then make a report, it takes somewhere around 6 to 1 year. That's 6 months to 1 year is kind of a time frame that we are looking at. So we'll come back to moment we are through with the process.
Okay. Thank you, sir. And my second question is, as you have mentioned earlier that in Kheda phase 1, company is expecting capex of 47 crores in FY24. So how much we have done already, or how much is still pending? So can we expect any additional capex other than this in this financial year?
Yeah. So thank you for this question. On the first part, let me clarify. The guidance was 50 to 60 crores of turnover from Kheda, phase 1 in FY24, which is this year, and we are on track for that. As I said, the first equipment will be dispatched in Q2, and most of the substantial portion should come in Q3 and Q4. On the capex front, the phase 1 we've already done. We've commissioned the plant, except minor capex that we will be needing for fine-tuning some of our investments. But otherwise, the major investments have been completed in Kheda.
Okay. Thank you so much, sir.
And then one, in case if I have not answered your first question that you asked, The type of proprietary items, I would not be able to disclose the actual item because of confidentiality clauses that we have with our licenses. But I can tell you that it's in the ammonia field where we are targeting towards the hydrogen circuit.
Okay, that's such a help. Thank you so much, sir.
Thank you so much.
Thank you. The next question is from the line of Chetan from Abacus Asset Management. Please go ahead.
Yeah, good evening, sir.
Hi, good evening, Chetan.
Yeah. Sir, a few of the questions that the order book which has now gone up to 650 crores, what is the time period by which you will be able to execute this? And at what margin these orders are bidded in?
Yeah, so most of these orders are 651 executable in this financial year itself. So that's where we are saying it will form the part of 520 to 530 crores. But of course, about 20% of it would be for next financial year. That's the reason we are saying about 220 crores will move to next year. And on the margin front, it would be around that same guidance margin of 20 to 23% EBITDA.
Great. And so Shera coming into the picture, how the bid pipeline has got changed because now we will be able to offer any more products which was earlier not possible. So how that has got changed if we compare to last year, our bid pipeline?
Yeah, so as I mentioned earlier too, Kheda is strategically placed on the national highway, Baroda-Ahmedabad highway. So that gives us the ability to make much larger products than my current facility in Odhav. So obviously your question is relevant that it would give us more inflow in terms of the inquiry bank. So if you want a number to be put at, it would be about 20% of my inquiry banks have gone up. So as we speak today, I've got roughly about 1,000 crores kind of an inquiry bank on my hand. And around 30 to 35% would be reactors, vessels and columns which are meant for Kheda.
Right.
So as I mentioned earlier, strategically we are moving with a roadmap that the heat exchangers will be made in Odhav facility and the vessels, reactors and columns will be made in Kheda facility, not because of anything else, but only the logistical constraints that we have in Odhav. Being in the city limits, the flyovers restrict us for moving larger diameter equipment. So that's the only reason why we have strategically made this choice.
Great, sir. And so lastly, one bookkeeping question. The employee cost during the quarter has gone up from 5.5 crores to 8.8 crores from a March quarter. Can you elaborate the reason for that?
Yeah, so what we've done, Chetan, this time is we've set in a new process in place that normally we have these performance bonuses and the salary revisions also coming in. Going forward and this year what we have started a practice is that the performance bonus we would pay out and the salary revisions we'll do it in the first quarter itself and also make the provisions of the year into that quarter. So that's the only reason you are seeing. Otherwise, if we had not done that, if you see last year we paid it in somewhere in quarter 3. So we've made that process change for better motivation of people and also to roll out bonuses at immediately after the year is ended.
So on a yearly basis, what should be the employee cost? Hello.
So on a overall at the end of the year, we are looking at about 26 to 27 crores.
Okay, sir. Okay, sir. Thank you.
At a 520 to 530 top line.
Okay, yeah. Thank you, sir.
Thank you, Chetan.
Thank you. The next question is from the line of Kunal Shah from Carnelian Asset Management. Please go ahead.
Hi, thank you for the opportunity and congratulations to Ravi and for a good set of numbers.
So sorry to interrupt, but the line for you is not clear. We request you to please use the handset while you're speaking.
Is it visible now?
This is a little better, sir. Please go ahead.
Yeah, so congratulations to Ravi and team for good set of numbers. I had two questions. One was, we have mentioned in our annual report of capability enhancement. You mentioned about polymerization reactors, high thickness reactors, orders in floating LNG, offshore space, etc. And also you did mention about increasing the query bank that we have. So two parts to this question. One was, how does the opportunity size increase for us with introduction of the new products? That was the first question. The second question was also, does it help increase the per unit average sale value with all of these new products, which can help us increase sales?
Yeah. Thanks, Jason. Kunal for that question. Yes, so with the introduction of KEDA, surely it increases our opportunity pipeline in a sense that earlier whatever we had to regret because we couldn't make it in order, now we are able to address the full basket of inquiries from the customer. So as I mentioned earlier, it gives us an opportunity increase of about 20% overall in terms of the bidding pipeline. These polymerization reactors and others that you mentioned, yeah, surely they were the first that we made. So this polymerization reactor was the first polymerization reactor ever made in India for an Indian project, of course, through a licensor in Europe. So it's very critical piece of equipment. So what it does is that it sets us one level higher in terms of the capability benchmarks. Since the equipments are so very critical. And as you know, we do not per se have a standard product. We basically sell our capabilities. Based on that, we make customized equipment. So when we move one level up in terms of our capability index, by making such critical equipment, the opportunities for such critical equipment go up. And then whenever such polymerization reactor plants come up, we surely have these opportunities up our sleeves when those projects hit the ground. So overall, I would say 20% increase in the opportunity pipeline or the opportunities that we would regret earlier would be at our disposal. I'm saying with the limited capacity right now in phase 1 that we have. Of course, when we start and venture into phase 2 and phase 3 of KEDA, that will end up into bigger capacities for us and we would be able to address a much larger basket of the inquiries.
Okay, interesting. And when do we plan to do capex for phase 2 in KEDA and of what amount?
Yeah, so as you know, in phase 1, we have built 1.5 day. To be precise. The overall master plan was for 7 days. So in phase 2, we have a plan for 2 more days and the balanced number of days in phase 3. Now, as I said in last call as well, with the capacity that we put in order now, plus the added capacity in KEDA with phase 1, we should be good to go with 700 to 750 crores kind of a turnover from this capacity. So what does this mean for us is that the decision on building a new bay, considering that it would take about 11 to 12 months for us to build, FY25 early is where we will make a decision of investing into the phase 2 because that is the right time for us to get going. And then we'll take a call at that point in time. So early FY25 is the right point for us to take a call and further investment in KEDA. Each bay should cost us, since now we have built all the utilities around the company, what we need to now invest is only in the manufacturing base. So each bay would cost us anywhere in between 50 and 60 crores to set up with a timeline of 11 to 12 months.
Okay, that's really helpful. Thank you, Ravi. And just one more question that's more on accounting question. The contingent liability as a percentage of net worth is at almost 45%. So this is a nature of the industry where we give guarantees, for advances that we receive. So if you could help understand how does this work, and with the increase in the scale of business that is going to happen in the next 2-3 years, how should one look at this particular aspect? And historically, have there been any performance guarantees that have been crystallized or anything of that sort would also be very helpful.
Right. Good question, Kunal. So right now we have a total limit of 325 crore rupees, of which 315 is a limit for a non-fund base, right? Of which, as on 30th June, 145 is a ABG, Advanced Bank Guarantee. So right now the average life of Advanced Bank Guarantee is a 1.23 years. So generally what happened, the project cycle would be the 7 to 8 months. So along with the order, we generally get a 10% to 20% advance, which is against the order. So as on 30th June, we sit on the advance of 82 crore rupees against the 143 crore ABG, which is on the advance of 82 crore rupees. Roughly 24 crore ABGs are such which is submitted to the customer, and we are expecting advance to be received in next 1 or 2 weeks. And there are 38 crore rupees worth of BG which is expired, and we are awaiting same to be received from the bank. Once received, we'll submit to the bank and that will get cancelled. So this one portion is a ABG. Second would be the performance bank guarantee, where the average life is a 3.5 years. So generally these products have a warranty. Customer asks us to submit a performance bank guarantee which would be in the range up to 1 year to 5 years. But in past, there is not a single incident where customer has invoked those bank guarantee. There would be some minor issues with the equipment which can be solved from back charge. If you go to a P&L, then this last year we had a 36 lakhs rupees of back charge charging. Other than that, there is no incident related to invocation of those bank guarantees. And the third portion of this limit would be the LC. So most of material we buy would be from the Jindal, then Nippon Steel and some other good companies where they ask us to give them an LC at a site or LC of 90 days. So we sit on the LC of roughly 20 crore rupees. So out of that 315 crore of limits, we have already utilized 355 crore limits. And that is the reason right now we are going ahead with the resolution of increasing this limit from current 350 to higher limits through shareholder approach.
Okay. Thank you. That was pretty helpful. But do we make any provisions on a regular basis for the guarantee that we provide, or we provide for it in P&L only when it incurs?
No, we provide a 0.5% provision that includes the LD, back charge and warranty. So of a top line, we provide this provision for 0.5%.
Okay, fair enough. Just one last question, if I may squeeze in. Now we are focusing on exports as well, right? So are we having any hedging strategy in place to hedge the currency movements, or how do you plan to kind of hedge that? Because if I understand correctly, with this current order intake also, we had a good part coming in from exports. So are we having any plan to kind of hedge, or how do we look at that? Correct me if I'm wrong, I could not find that in annual report pertaining to hedging anything.
Yeah. So till last year, we haven't hedged any of our foreign exposure. From this quarter, we have started considering the possibility of hedging the foreign exposure, especially USD currency. But our first strategy would be to safeguard the denominator which we have taken while giving a quotation to the customer. So right now, when we see the dollar between 82 and 82.30, so we are in discussion with our treasury team, and probably by end of this month or next month, we'll hedge the portion which is receivable in next 2 quarters.
Okay, fair enough. I think that would be great, because that protects us, if anything adverse, just in case has to happen, and can protect our margins as well.
Yeah.
So thank you. I think that helps answer a lot of my queries. Thank you so much, and wishing you all the best.
Thank you, Kunal.
Thank you, Kunal.
Thank you. The next question is from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Yeah, namaskar, sir. Hello?
Yes.
Yes, sir. Sir, thank you for this discussion, sir. It's in depth and covering all the points. Sir, for the bid pipeline, you did mention that with Kheda now being operational, we can target now the 1,000 crore bid pipeline that we were earlier not able to do. This is what you commented, sir, earlier.
Sorry, I couldn't get few of the words. Could you please repeat the question, please?
Yes, sir. Sir, in the earlier conversation, you mentioned that now with the commissioning of the Kheda facility, we could now bid for orders to the tune of 1,000 crore, which was not earlier in our ambit. So this was your remark that now the bid pipeline through Kheda is to the tune of 1,000 crore?
No, so let me clarify. So what I mentioned was that as we speak, we have an inquiry bank of 1,000 crore. That includes both Odav as well as Kheda. But with Kheda now, 20% of this, about 200 crores, which we normally would have regretted because of the size limitations in Odav, now we are able to quote for that and probably win that order. So it gives us approximately about 20% better inquiry bank, and then of course the strike rate depends on the profitability and how well the negotiations go now.
Right, sir. And sir, earlier conversation you had also explained the point about exotic products, wherein we would be having incremental margin than what the regular margins have been in the vicinity of 22 to 23%. So how much of the order book do we have any of that exotic product, or what is the status on the same in terms of the garnering and executing those products?
Yeah, so on the order book that we have today, we roughly have about 5%, which is on the leaner material side, which we call as exotic. 5%. Of course, we wish to increase it further, but those projects, as you very well understand, they are not too many in the market. They come limited, but of course they get better winnability for us because only top 2 or 3 players can participate in those. So the direct answer, about 5% of the current order booking would be in the bracket of the exotic products, and we wish to increase it as we move forward.
Okay. And then taking into account the talk and the feel which we get from the European market in terms of the recessionary trends prevailing there, how would that impact our trend in the business going ahead? So if you could give us some understanding of how are you visualizing 25-26 going ahead, sir?
Yeah, so as you know, we all would agree that we are definitely having a good tailwind as compared to as we speak of the market. The capex cycle is really good, so it augurs well for manufacturers like us into the capital goods segment. Having said this, domestic of course still poses a lot of potential for us in terms of picking up orders. On the export side, as I mentioned earlier also in my call, we are a little measured right now because of the geopolitical situations around. There are 2 regions we are mainly focusing on today. One is United States of America and the other is Middle East. Now, these are the 2 prominent geographical regions where we are focused on because we are a little cautious of doing business elsewhere. Of course, in the European side, largely if you look at our order book and the execution, you would not find much projects of this oil and gas and petrochemicals in Europe. It is more of the end EPC contractors who are in Europe or the licensors who are in Europe. So they would release the order for us, but it will be for a project in some other regions. It could be Middle East or United States of America. So per se, we are not impacted too much by that, and largely our focused market is also United States of America and Middle East for now.
Correct, sir. And for the domestic market, sir, the pillars are from the refinery segment, that is the private, the public sector refineries only. The main thrust is from them, or the private participation is also there. If you could split the order book for the domestic segment between public and private.
Yeah. So last year it was more dominant on the PSU side. But this year I can tell you that even it could be a 50-50 kind of a mix, based on the projects that we are bidding, which should be finalized in a couple of months. There are pretty large private players also who are expanding their petrochemicals and refining segment.
Okay. And you mentioned the last point. You mentioned that we will be closing this year order book at what we have closed for now. 600 crore plus would be the expected order book as of 31st March 24, with an execution cycle of 535 crore for FY23-24. This is what the number is.
Yeah, that's correct. So we will be booking an overall new order book into this year of close to about 600 plus. And the revenue for this year, FY24, will be 520 to 530 crores as per our earlier guidance.
Right, sir. All the best to the team, sir. And thank you once again and I hope that at quarter 2 also we get an opportunity to interact with the management team.
100%. It's a pleasure to be talking to you.
Thank you, sir. Same here, sir, and all the best. Namaskar.
Thank you. The next question is from the line of Atharva Buttada from Purnartha. Please go ahead.
Hello, sir. Thank you for letting me ask this question. I just wanted to understand what the replacement cycle for your products are, and have we seen customers coming back for maintenance of vehicles or replacement of their older vehicles?
Yeah. So thank you for the question. So the answer to the first question is the average age of our equipment would be anywhere between 15 to 25 years kind of a thing, depending of course on the service. It varies based on the service. Heat exchangers, it is more of replacement of bundles. So there is something called as a bundle inside. So heat exchangers, you get frequent maintenance during shutdowns. And that is the product which is more dominant to us. If your question is what is the kind of business that we get from replacement, it's not too heavy right now. It's about 5 to 8% kind of business comes from replacement. Most of it comes from expansion or a new greenfield project.
Okay, sir. And one question was that more thickness brings more margins because they are difficult to make, right?
In one way, you're right. Yes.
So, what is the thickness for most of our products, and will we increase it multifold? Yeah.
So the highest thickness that we made, which is there in our report as well, was 185 thick, 180 base thick with some cladding on it. So that is the highest thickness that we ever made. Of course, we have a capacity to roll. We have the rolling machines which can roll even 200 millimeters. But of course, as of now, we made 180. Average thickness, since our larger portfolio is on the heat exchanger side, you will find average thicknesses varying between 50 to 80 millimeters thick. That's the kind of thicknesses that average out over our product portfolio. And when you say that larger the thickness, better the margins, in a sense, what I would put it is that yes, as the thicknesses go up, the competition is limited. That means you play with 2 or 3 players in India. So obviously, your probability of getting higher margins is higher.
Okay, sir. And so in quarter 2 FY23, we got an order of 36 heat exchangers for 100 crores. So I just wanted to understand if that order book has been completed, and because it was a big order, was it a low margin order?
So we've largely completed, except so you would say almost done. We have closed that order. That was for 100 crores.
Okay, sir. Thank you.
Yeah.
Thank you. The next question is from the line of Abhilash Shah, an individual investor. Please go ahead.
Yeah, good evening. This is Abhilash. I'm an individual investor. First of all, congratulations to the team Anup for executing. And my question is that, what is the roadmap for FY26 and FY27?
So, hi Abhilash, good evening. So as we mentioned in our guidance, we wish to grow year on year at a 25 to 30% kind of a growth level for the next 3 years. That's the kind of guidance.
Okay, so you tend to maintain the 25 to 30% growth for the next 3-4 years.
Yes, next 3 years.
Thank you. Thanks. That's it.
Thank you.
Thank you. We have the next question from the line of Ajay Surya from Niveshaay. Please go ahead.
Hello.
You're audible, sir. You may proceed with your question.
Yeah, congratulations on a good set of numbers. So my question is more on the heat exchanger side. So if I look at the capex in the private market, so if I assume that 1 lakh crore of capex is happening in refinery industry, so what is the opportunity size for heat exchanger as a product, and how much of that caters down to Anup Engineering? If you can throw some light on that.
Yeah, so thanks Ajay. So if you look at the proportion of exchangers in a project, depending on the investment, it largely would, Ajay, I'm sure you would appreciate that it would depend on the type of project that's coming in. If it's a refining, the proportion would be completely different. If it's a petrochemical, it would be completely different. But over a ballpark number, averaged out from the perspective of a project of an average size in nature, the exchangers would be anywhere between 40 to 50%, and balance would be reactors, columns, and vessels. Of course, I'm saying it would vary drastically depending on what kind of project it is. But averaged out, you could take this sort of number.
No, but my question is more on like what is the opportunity size for the number, ballpark numbers, like if at 1 lakh crore kind of capex happening in refinery. So would that slow down to 4,000, 5,000 crore of heat exchanger kind of demand in the industry or not? That is more what I would like to know.
Okay. So I would respond from the perspective of Anup's interest in that kind of a range of exchangers, because there would be a lot of other heat exchangers which are very small in nature, where we don't wish to participate and we do not even track those kind of orders. But what is relevant to Anup's product portfolio, it's an average about 9,000 crores kind of an opportunity every year in the global market.
Okay, sir, got it. So, sir, my next question is on, like, basically if I look at the overall heat exchanger market, majority is obviously shell and tube heat exchanger, but again, air-cooled heat exchangers are also gaining a lot of traction in the refinery side. So, is there any trend in the industry where refineries are preferring a mix of both air-cooled and shell and tube, and not just preferring shell and tube? So is it like air-cooled are replacing the demand of shell and tube? Can you just throw some more light on that? That's what's happening in the industry, and what are the trends towards the product mix which is happening in the industry?
Thanks, Ajay. I sincerely appreciate you tracking this market so closely. So as you rightly said, yes, the air-cooled heat exchangers are also gaining traction. Largely from the perspective of water scarcity, because air-cooled condensed heat exchangers could work without fluid. Now, if the question is why, when the traction is there, Anup was not in the picture, we didn't venture out into this product, is air-cooled heat exchangers generally need a large space. so it actually consumes a lot of floor space for you. Now with Kheda in picture and with further land available for us to expand, I wish to say that we are sincerely looking at it. We've had some great discussions over it. We will make a decision soon on that particular product. But you're right, it is a product which is gaining traction. But I would also make a point that knowing that product, we know it's not a very high margin product.
Okay, sir. Thank you so much on that.
Thank you.
Last question would be, like, we have mentioned in the presentation that we have gained 3 new customers, that is like Graham, Endorama, and ITT. So can you just throw some more light on, like, what time did it took for us to gain these customers, or what are the approval cycles that we have to pass through to gain new export customers?
No, so these 3, as we mentioned, are very strategic customers for us, and it's on a strategic direction that we want to gain traction into larger geographical base. So that's where the whole process of connecting, as I mentioned earlier, of getting the customers to audit your facility, because finally our capabilities are more important to a customer. So it takes anywhere between, depending on the licensor and the customer and the stringent requirements, it would take anywhere between 6 months to probably 2 to 3 years to get them on board. And of course, once they qualify, then you have to bid for the inquiries. You should be in a position to win with a better price and of the right quality. So we are happy to have these 3 customers on board. We've been trying to get orders from these customers for probably a year, 1.5 years.
Great, sir. Great. All the very best for the coming time. Thank you.
Thank you so much. Thank you.
Thank you. We have the next question from the line of Atharva Buttada from Punartha. Please go ahead.
Actually, I just had one question regarding the raw material that is majorly used in the contracts that are given in the contract for heat exchangers.
Yeah, so on the contract for heat exchanger, if you look at the raw material content, Atharva, it is largely on the tube side. So larger portion would be tubes. Of course, we have a larger sourcing within India for tubes. We have very good sources in tubes, and it would be plates, which are the next buying, where we have good reputed suppliers in India, like ArcelorMittal, Nippon Steel, and Jindal.
Okay, sir. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Ankit, an individual investor. Please go ahead.
Good evening. Can you hear me?
Yes, good evening, Ankit. We can hear you clearly. Please go ahead.
Yes, congratulations for a great set of numbers. Just wanted to clarify, in one of the earlier questions, you said that out of the 600 crore order book which the company has currently as of Q1, most of these orders will be executed in this fiscal year, and only around 20% would get rolled over to next year. So that implies almost 500 crores will be booked this year, and we have already reported around 120 crores in Q1. So is my understanding correct? So it would be 120 plus 500, or am I missing something here?
Yeah, let me clarify. So the order book position as we opened up, or even if you take the Q1 end, is showing roughly 650 crores, right? That's the order book position as on today. We have already clocked 125. What we are saying is FY24, we will be 520 to 530 crores kind of a revenue. So what does that translate? That translates, as we speak, 220 crores for FY25. Of course, that will further build on as we book orders in the coming quarters, which will be largely for FY25. And the overall order book, new order book in this year, which is 240 now in the quarter one, we wish to take that to about 600 plus in this year. New order book.
Okay, understood, sir. And so even if you look at the trailing 12 months revenue, it's already at 485 crores. So which implies not a very significant growth for the next 9 months. Any reasons to be conservative and not revising the guidance upwards? Or you just want to wait for one more quarter before giving us more update on the guidance?
So, Ankit, what we are saying is based on the workings, because every project has got a timeline of completion and the revenues are generated. So we don't go by POC method, we go by actual dispatch method. So based on the dispatch dates when the customers would pick up the equipment from our side, based on that we have a firm understanding that we would be around 530 crores in this quarter, which surely means the earlier guidance that we had given, so we would be in the bracket of 25 to 30% growth, and that's what we wish to continue in the next 2 to 3 years.
Okay, and so last one from me. Are you seeing any impact from the higher interest rates from your customer side? Are there any delays in the capex? Anything which you are seeing, or the other inquiries are very good and very strong even at the higher rates?
So we are not seeing that, Ankit. Of course, having said that, there are specific projects where we see a little bit of holdback, not because of the interest rate or because of anything else, but because of their end product demand, they are a little bit of doing research on that. So, but largely, if you see, the capex cycle is really at the peak today, and we expect next 2 to 3 years to be continuing this trend. Mainly because as you know, I'm sure you're tracking the steel prices. This is the best time for any projects to be invested because the steel prices are at a lower base as compared to what you've seen probably a year back.
Yes, sir. Yeah, thank you. That's all from my side. Thank you for the opportunity.
Thank you so much, Ankit. Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Reginaldo D'Souza for closing comments. Over to you, sir.
Yeah. So as we have now announced the quarter one numbers, I'm extremely pleased of this performance. And as we have the guidance for the year of 520 to 530 crores, with an EBITDA of 22% to 23%. So with a great beginning, I'm pretty sure and confident that we are on track for this particular plan. So I once again thank you everyone for a very interesting and interactive session. We were quite happy responding to all the queries and clarifications that you had, and I'm sure going forward as well we will have your understanding, support and guidance as we take this journey to a glorious future for Anup Engineering and a win-win position for all our stakeholders. So once again, a big thank you. Happy to interact with you, and stay safe and take care. Thank you so much.
Thank you. On behalf of the Anup Engineering Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.